Welcome to the Deep Dive. Today, we're tackling a topic that often feels pretty overwhelming, especially if you're just starting out investing.
It's really easy to get tangled up in all the strategies, the predictions, the endless choices, it seems.
It really is. And that complexity, well, it can be a huge barrier for people.
But our source material today, it sort of cuts through all that noise. It suggests that effective investing can actually be, well, surprisingly simple.
That's the promise, isn't it? We're diving into insights mostly from John C. Bogle's classic book, Common Sense on Mutual Funds.
A foundational text for many investors.
Right. And our mission here, in this deep dive, is to pull out the absolute core ideas, the essential nuggets of knowledge from this text that really simplify investing.
Mhm.
We want to show you what truly, fundamentally matters according to these principles.
Think of it like getting a clear roadmap. No nonsense based on decades of market experience and data, all boiled down into just a few really powerful ideas.
And here's what I find fascinating. It almost runs counter to how the financial world often talks, doesn't it?
It does.
The source suggests the path to success isn't about finding the most complicated strategy or chasing the hottest fund manager.
No, quite the opposite. Let's unpack this simple, powerful principle.
Okay, so according to this source, where do many investors, maybe even the industry itself, go wrong? What's the big problem it points to?
Well, the book is pretty direct about this. It talks about the relentless pursuit of unrealistic performance practiced through costly short-term strategies.
Okay.
The argument is that this focus, this obsession with trying to beat the market rather than just owning it, is a huge distraction, and ultimately it works against the average investor.
And it suggests this isn't just bad luck, right? That the structure of the mutual fund industry, at least as it developed, kind of contributes to this.
Exactly. The source points to let's say, a fundamental shift, where the industry's focus moved, perhaps subtly at first, from purely managing investments for the benefit of the fund
It's
owners.
the shareholders.
Right, the shareholders. Towards focusing more on marketing, on gathering assets under management, and generating profits for the management company itself.
I see. So decisions might be driven more by what grows the fund company, not necessarily what's best for the investor's long-term wealth.
That's the concern raised in the source. Yeah,
Yeah.
it can create potential conflicts.
And that impact, the negative impact on the investor, it shows up really clearly in one specific place, doesn't it? Costs.
Costs. This is probably the single most critical point the source makes. It just hammers it home again and again. Costs are a direct drain on your returns.
Okay, let's break that down. There are the obvious costs, like the expense ratio.
Right, the expense ratio. That's the annual fee charged as a percentage of your investment value. The book notes typical corporate expenses, mainly management fees, often average around 100 basis points.
100 basis points. Just to clarify for anyone new to this, that's just another way of saying 1%. Correct.
Exactly, 1%. And 1% might sound small, almost negligible.
It does.
But the source uses some really powerful examples to show how significant that 1% drag is against your investment growth, especially when it compounds year after year.
And it's not just that annual expense ratio, is it? There are other, maybe less obvious costs hiding in there, like from frequent trading within the fund.
That's right. The source calls this high portfolio turnover. If a fund manager is constantly buying and selling stocks, trying to time the market or pick winners,
Right.
that activity generates transaction costs. You've got brokerage fees, you've got bid-ask spreads, market impact costs. It all adds up.
And the source puts a number on that.
It estimates these trading costs could be around, say, 0.8% of the value of each trade. So imagine a fund with a 50% annual turnover rate, meaning half its holdings get replaced each year.
Okay.
You could potentially be adding another 0.8% or even more in these sort of hidden costs annually, on top of the stated expense ratio.
Wow.
The source calls this total drag a significant fiscal drag on returns, like an unseen tax just constantly eating away at your potential gains.
So let's bring it back to the listener. Why should you, the investor, care so deeply about these seemingly small percentages, 1% here, maybe 0.8% there?
Because every single one of those basis points, those fractions of a percent in costs, they are subtracted directly from whatever the fund's investments actually earn before you ever see a dime.
Ah, okay.
It's a guaranteed reduction in your share of the market's return. The market provides a certain gross return, and these costs simply take a slice of it every year.
Like a toll booth on the investment highway.
That's a good way to put it. And the source argues really compellingly that controlling these costs is one of the only things you, as an investor, can reliably control. And it makes an enormous difference over the long term.
Okay, so if the problem is chasing performance through these complex, costly strategies, what's the simple, common sense solution presented in the source?
The simple solution, according to Bogle, is indexing. Just indexing.
Index.
Instead of trying to beat the market, which the source shows with data, is an incredibly difficult game to win consistently, especially after you factor in those costs we just talked about.
Right.
The idea is to simply own the market, or a broad slice of it.
Own the market. How does an index fund actually do that? What does that mean practically?
Well, an index fund doesn't rely on a manager trying to pick the next winning stock or time the market swings. It's passive. It simply holds a diversified basket of securities designed to mirror a specific market index.
Like the S&P 500.
Exactly. S&P 500 is the classic example. It represents 500 of the largest U.S. companies. So an S&P 500 index fund just buys and holds shares of those 500 companies in roughly the same proportions as they exist in the index itself.
Minimal trading, just holding.
Minimal trading. And the source highlights, the Vanguard 500 index fund, which Bogle himself launched back in 1975 as the very first market index mutual fund available to individual investors, a real game changer.
And the core argument for why this simple approach works so well, it's really rooted in the data, according to the source.
Absolutely. The data presented in the book is, well, pretty compelling. It shows year after year, decade after decade, that the vast majority of actively managed funds fail to outperform their benchmark index after accounting for their higher costs.
Why is that? Is it just that picking stocks is hard?
It's partly that, but it's simpler math, too. Think about it. The total market return is the average return of all investors combined before costs. So before costs, about half of the money invested will beat the average and half will underperform. Simple arithmetic.
Okay, makes sense.
But then you add in the costs, the higher expense ratios, the trading costs of those active funds, and suddenly the average active investor falls behind the market return, often significantly. The index fund, with its rock-bottom costs, captures nearly the full market return.
And the source gives specific examples of this advantage, right? I remember something about balanced funds.
It does. It presents data showing that a balanced index fund holding both stocks and bonds consistently delivered an annual return advantage of somewhere between 0.6% and 0.9% compared to the average actively managed balanced fund.
Almost a full percentage point per year.
Yeah. And the key driver wasn't some genius management in the index fund, it was simply costs. The index fund might have had an expense ratio around 0.2%, while the managed funds averaged 1.0% or more. That cost difference, that roughly 0.8%, flowed directly through to the investor as higher net return.
And over the long haul, over decades, that seemingly small annual difference, it must have a dramatic effect.
Huge effect. This is where the source talks about the tyranny of compounding. That small difference in annual returns, maybe just 0.8% or 1% lower because of costs, it doesn't just add up linearly, it compounds.
Okay.
The book has these really eye-opening examples, like take a $10,000 investment. Over 15 years, even in a tough market, the index fund capturing, say, 99% of the market's return might grow to $30,900.
Right.
But the average managed fund, maybe only capturing 87% of the market's return because of higher costs, might only reach $24,000 in the same period.
Wow, that's almost a $7,000 difference.
Exactly. Almost $7,000 less for the investor in the higher cost fund. And that difference is overwhelmingly due to that relentless drag of costs, compounded over time. It's a really stark illustration of how costs silently eat away at your potential wealth.
So lower costs lead to better returns. What about risk? Does the source touch on that?
Yes, another really key finding. The source presents data indicating that broad market indexes and the index funds that track them tend to have substantially lower risk than actively managed funds as a group.
How do they measure that risk?
Typically using standard deviation, which basically measures how much an investment's returns tend to bounce around its average.
Right.
Volatility.
Higher means more unpredictable swings.
Right. And the source shows index funds often had maybe 30% lower standard deviation than the average active fund, which makes sense, really. They're incredibly diversified across the entire market, reducing the risk you get from concentrating bets in fewer stocks.
Okay, let's really double down on this cost idea again, because the source seems to emphasize it above almost everything else. It gets really impactful here. The book basically makes the case that costs aren't just one factor in your returns. They are the single most reliable predictor of your net return.
That is absolutely the core takeaway from the data presented. It's not about finding the manager with the best past gross returns, because that's hard to predict. It's about finding the fund with the lowest cost.
And there's data showing this directly.
Yes. There are tables in the book where funds are sorted by their costs, like into quartiles, from lowest cost to highest cost. And in one period shown, the lowest cost group of large cap stock funds had an average expense ratio of maybe 0.7% and ended up with a net return of, say, negative 2.3% in a down market. The highest cost group, they had a 2.0% average expense ratio. Their net return was minimal 3.4%.
A much bigger loss for the investor.
Exactly. Even if their underlying investment picks, the gross returns were roughly similar before fees, those much higher expenses in the second group just wiped out significantly more of the return, leaving the investor much worse off. Lower costs directly translated to higher net returns or smaller losses for the investor. It's incredibly consistent in the data.
And we haven't even really factored in taxes yet, have we?
Ah, yes, taxes, which the source rather colorfully calls the industry's black sheep. Often ignored, but hugely important for taxable accounts.
How do they impact things?
Well, those actively managed funds with high turnover, always buying and selling, when they sell a stock for a profit, that generates a capital gain.
Right.
If you hold that fund in a regular taxable brokerage account, not an IRA or a 401k, those gains often get distributed to you, the shareholder, usually at year end. And guess what? You owe taxes on those gains, even if you never sold a single share of the fund yourself.
Oh, so you get a tax bill just for holding the fund.
Pretty much. It creates this ongoing tax drag that further eats into your real after-tax return. Index funds, on the other hand, with their very low turnover.
Because they just buy and hold.
Exactly. They generate far fewer of these taxable capital gains distributions. This makes them much more tax efficient, especially if you're investing outside of a retirement account. It's another significant, often overlooked advantage.
Now, we should probably acknowledge this source, Common Sense on Mutual Funds, has been updated, but its core message originates from a time before certain products became as dominant as they are today, like ETFs, exchange-traded funds.
That's a really important point for context, yes. The book does discuss early ETFs, like the SPDR S&P 500 ETF, often called the Spider, but its perspective, based on the data available at the time the book was written, was actually quite cautious, especially when comparing them to the traditional index mutual funds he championed.
Interesting. What were the specific concerns about those early ETFs back then, according to the source?
The source highlighted a couple of main issues at that time. First, while these early ETFs generally had lower expense ratios than actively managed funds, which was good, many of them actually carried annual expense ratios that were significantly higher than the classic super low-cost index mutual funds Bogle preferred.
Oh, really?
Yeah, he cited examples like 0.50% to 0.70% expense ratios for some early ETFs compared to maybe 0.10% to 0.15% for comparable traditional index funds back then. So the cost advantage wasn't always there compared to the best mutual fund options.
Okay, that's one point. What was the other?
The second point, and perhaps the more critical one from the source's philosophical perspective, was about investor behavior. The data available at that time showed a significant gap. The returns that actual investors were getting in ETFs lagged the performance of the ETFs themselves by a surprisingly large margin.
Wait, how does that happen? If the ETF tracks the index, why would the investor do worse?
Good question. According to the source's analysis back then, the problem wasn't necessarily with the ETF structure itself accurately tracking its index. The lag was attributed primarily to how investors were using them. Because ETFs trade like stocks all day long on an exchange, the source suggested investors were using this intraday trading capability to, well, trade frequently, to try and time the market, jumping in and out.
So using a tool designed for long-term, low-cost investing for short-term speculation instead.
Precisely. That active trading behavior by the investor generated its own transaction costs, brokerage fees, and often led to poor timing decisions buying high, selling low. This effectively undermined the core benefit of low-cost buy-and-hold indexing that the ETF vehicle itself could provide. The source cited data suggesting ETF investor returns lagged the sectors they tracked by something like 4.2% per year over one 5-year period studied back then.
Wow, that's a huge gap and a really powerful observation from the source that it's not just the investment product, but how you use it that matters. Using a simple tool in a complex way can defeat the purpose.
Exactly. It underscores the importance of discipline and sticking to the long-term strategy, regardless of the investment vehicle.
Okay, so beyond the core message of indexing and low costs, what other simple common sense principles does the source touch upon that are useful for investors?
Well, it definitely discusses asset allocation. That's, how you divide your money between different investment types, most commonly stocks and bonds.
Right, the mix matters.
It does. The source suggests using things like your age and your general comfort level with risk as starting points. For example, it proposes a general guideline, maybe like holding your age in bonds, reducing your stock exposure, and increasing bond exposure as you get older.
Why bonds?
Because bonds, while they usually offer lower potential growth than stocks, tend to be much less volatile. They can act as a kind of cushion or ballast in your portfolio, helping to moderate the risk, especially during those inevitable stock market downturns.
Makes sense. What about investing outside your home country, globally?
It covers international markets, too. And importantly, it notes that the exact same principle of low costs applies just as strongly there. International index funds typically have much, much lower expense ratios than actively managed international funds.
Any numbers on that?
The source suggested targeting expense ratios maybe not exceeding 0.5% for index funds covering developed international markets, or perhaps 0.75% for emerging markets. That's far below the 1.7% average expense ratio it observed for actively managed global funds at the time.
Still a big cost difference.
Huge, though it does add a note of caution, particularly about potential risks like transparency issues or governance concerns in certain emerging markets back then, something to be aware of.
And just to reiterate, costs matter just as much for bond funds as they do for stock funds, according to the source.
Absolutely, yes. The data presented clearly shows the same pattern in bond funds. Lower costs directly lead to higher net returns for the investor over time. The source even commented on the surprising lack of truly low-cost bond fund options available when it was written, although thankfully that situation has improved quite a bit since then.
Okay, so let's try and pull all of this together, particularly thinking about someone who's just starting their investment journey, maybe feeling a bit lost in all the noise. What is the really distilled core message from these sources? What does this all mean for you, the listener?
I think the overwhelming message, really anchored by Bogle's work and common sense on mutual funds, is this. Investment success for the vast majority of people isn't found in complexity. It's not found in trying to predict the future or paying high fees to supposedly expert active managers who, the data shows, are very unlikely to consistently outperform the market after you account for their costs.
So forget trying to find the needle in the haystack.
Pretty much. Instead, success is found in simplicity. It's found in relentless cost control and maintaining a long-term perspective. By choosing simple, broadly diversified, low-cost index funds.
And the source, based on its historical analysis, really emphasized the benefits of the traditional index mutual funds for buy and hold investors.
Right, particularly due to the concerns about investor behavior with early ETFs noted at the time. By using those simple, low-cost vehicles, you essentially guarantee yourself a return that's very, very close to the overall market return.
You're not trying to win the race by finding some secret shortcut.
Exactly. You're simply ensuring you don't lose the race by avoiding the biggest drags on performance, which the source identifies clearly as costs and, for taxable accounts, taxes.
It sounds like it's about being a patient, long-term investor, not a short-term speculator.
That's it, precisely. It's about letting the power of compounding work for you over decades, participating in the broad growth of the economy through owning the market, rather than getting sidetracked by the speculation, the hype, the complexity, and especially the cost that the source argues ultimately just erode your hard-earned returns.
Which leaves us with a final thought, perhaps, for you to consider as you think about your own financial path. If the most reliable road to investment success, according to this common sense source, is simply capturing market returns while minimizing the corrosive effect of costs over the long term, are you perhaps currently being pulled in other directions? Maybe distracted by complexity, by market noise, by hype, or by that alluring but often disappointing promise of trying to beat the market? Something to reflect on.